BWS continues to brief you on financial facts, market signals, and wealth ideas.
This week, from February 23rd to 27th, U.S. equities closed broadly lower. The S&P 500 slipped roughly 0.4% on the week, ending near 6,878. The Nasdaq Composite fell more sharply, down about 0.9% to 1%, closing around 22,668. The tone shifted notably as the week progressed.
Market sentiment was volatile from Monday through Wednesday. Early selling was triggered by renewed tariff headlines, followed by a midweek rebound as dip buyers stepped in. But by Thursday, the mood turned decisively more cautious. Friday amplified downside pressure, with selling accelerating into the close. The underlying drivers were not technical alone, they were macro and structural.
A key catalyst was hotter-than-expected inflation data. Core Producer Price Index rose to 3.6% year-over-year, above consensus expectations. That reading suggested that tariff pressures may be transmitting further into the supply chain and potentially toward consumers. The data revived concerns about stagflation, a scenario of sticky inflation combined with slowing growth.
At the same time, AI-linked valuations began to compress. After 2 years of extraordinary multiple expansion, particularly in large-cap technology, investors are reassessing long-term return assumptions. Add tariff uncertainty and escalating Middle East tensions to the mix, and the result was a rotation out of growth and into more defensive positioning. Profit-taking also intensified volatility. Many institutional portfolios remain heavily concentrated in mega-cap technology, especially the so-called Magnificent Seven. Over the past 2 years, capital flows have disproportionately favored these names. As positioning became crowded, even strong fundamentals were not enough to prevent de-risking.
In fact, a central narrative this week was whether markets are entering the late-middle phase of an AI-driven bubble cycle. Concentration risk is elevated. Market breadth has narrowed. A small group of stocks has accounted for the majority of index gains. Historically, such setups can amplify both upside momentum and downside correction phases.
Among the most watched names was Nvidia. The company reported strong earnings and issued revenue guidance above expectations. On fundamentals alone, the quarter was robust. Yet the stock declined approximately 9.4% during the week. This divergence between results and price action is telling.
The decline reflected what traders often call a sell-the-fact dynamic. Investors are questioning the durability of AI infrastructure spending, long-term competitive dynamics, and valuation resets. Importantly, there is little evidence of demand collapse. Rather, the market is recalibrating what it is willing to pay for future growth. Turning to monetary policy, the Federal Reserve maintains a neutral to slightly restrictive stance. The federal funds rate remains in the 3.5% to 3.75% range. Following January's meeting pause, markets now expect only 1 to 2 25 basis point cuts in 2026, a notable shift from earlier easing expectations.
Chair Jerome Powell continues to emphasize data dependency. The Fed has signaled patience. If inflation fails to show sustained progress toward 2%, policymakers may delay further easing. There are no clear indications of a pivot back toward quantitative easing, nor an abrupt change in balance sheet policy.
Inflation volatility is reinforcing a more hawkish interpretation of forward guidance. Policymakers have repeatedly stated they require greater evidence that inflation is sustainably returning to target. This reduces room for aggressive rate cut speculation and increases sensitivity to each macro release.
Policy uncertainty adds another layer. Tariff developments under the Trump administration, including a new 10% tariff following a Supreme Court ruling, have injected unpredictability into trade policy. Combined with ongoing Middle East tensions, geopolitical risk is feeding into commodity markets and inflation expectations. Overall, this week reflected a market wrestling with 3 forces: elevated valuations, persistent inflation, and policy ambiguity. When these forces intersect, volatility tends to rise. Now, attention turns to the week beginning March 2nd, which brings several critical catalysts.
First, macro data. On Wednesday, ADP private payrolls will provide an early signal. Thursday's initial jobless claims will offer labor market context. The most significant release arrives Friday, March 6th, with the February non-farm payrolls report, including unemployment rate, average hourly earnings, and headline job creation.
Beyond labor data, markets are already positioning ahead of CPI around March 11th and PPI around March 12th. These inflation prints will test whether price pressures remain stubborn. A hotter-than-expected CPI or PCE reading would likely strengthen the hawkish narrative and pressure equities.
Conversely, if inflation shows cooling while employment weakens, markets may revive expectations for earlier easing. In that scenario, risk assets could find support. The balance between inflation persistence and growth resilience remains the central macro trade. Second, Federal Reserve communication. The next FOMC meeting is scheduled for March 17th to 18th, including a press conference. While no policy decision occurs next week, several officials may speak publicly, including Williams, Kashkari, and Hammack.
If their tone hints at a potential summer rate cut path, risk assets could respond positively. However, any reaffirmation of patience or concern about inflation stickiness would likely reinforce volatility. The policy narrative is highly sensitive to nuance at this stage of the cycle.
Third, earnings season aftershocks. While the bulk of reports are complete, select early March reporters may update first quarter guidance. Investors will closely monitor whether AI-related firms continue to experience sell-the-fact reactions similar to Nvidia, or if sentiment stabilizes.
Fourth, market positioning and technical levels. The S&P 500 is trading near its 50-day moving average support. Meanwhile, the CBOE Volatility Index, the VIX, has rebounded toward 19. If inflation surprises to the upside or Fed rhetoric turns firmer, a test of lower support levels becomes more probable. Sector rotation will also be important. Defensive sectors such as utilities and consumer staples may attract incremental flows if macro uncertainty persists. Conversely, renewed momentum in technology would require stabilization in yields and inflation expectations.
Fifth, geopolitical and policy developments. Tariff negotiations involving the US, China, Canada, and Mexico remain fluid. Any new announcement could move currency and equity markets quickly. Middle East tensions, particularly involving Iran, continue to influence oil prices and inflation forecasts.
Market voices may also shape sentiment. If investors like Michael Burry reiterate bubble warnings, caution could deepen. Alternatively, optimism from figures such as Cathy Wood might reinforce long-term AI enthusiasm.
Finally, commentary from Warren Buffett, if any emerges, would likely impact value-oriented sentiment. In concentrated markets, influential perspectives can temporarily shift narrative direction. In summary, markets are balancing strong structural innovation against cyclical inflation risk and policy uncertainty. The coming week's data will test whether disinflation resumes or stalls. Positioning remains sensitive and concentration risk is elevated.
For investors, discipline matters. Diversification, risk management, and awareness of macro catalysts are essential during late-cycle valuation phases. Volatility is not necessarily bearish, but it requires preparation.
We will continue monitoring inflation signals, Federal Reserve messaging, sector rotation, and geopolitical developments. In markets shaped by narrative and liquidity, clarity often arrives gradually, not instantly.
This has been BWS, your briefing on financial facts, market signals, and wealth ideas. Stay measured, stay informed, and we will see you next week. Thanks for watching. Please subscribe our channel. See you next time.